Welcome back to the Deep Dive. Today, we're jumping into the Q4 and full fiscal year 2025 results for Mueller Water Products. That's ticker MWA. And this one is a classic earnings call paradox.
It really is a total head scratcher.
Right.
And that's what we're here to drill down into.
Right.
The company delivered, a record performance. It's the culmination of this huge multi-year operational story.
And
yet the market reacted with, swift skepticism. The stock pulled back pretty hard, dropping over 4% right after the release. So our mission is to figure out why. Why did the market just ignore the party and focus on the cautious words in the guidance?
Okay, so let's start with the hard numbers for Q4, because you can't argue with them. They were, frankly, phenomenal.
Absolutely.
MWA delivered an adjusted EPS of 38 cents. And this wasn't just a small beat, it was a strong beat.
Right.
It flew past the consensus estimate of 34 cents.
Yeah, that's an 11, maybe 12% beat and up, 73% year over year? Just a staggering number.
A staggering number. And it wasn't just, bottom line magic. Sales were really robust.
For sure. Net sales hit $380.8 million. That's a 9.4% increase year over year.
Okay.
And that top line number beat expectations by a really meaningful $15 to $19 million. So, you've got a clean beat on revenue, a clean beat on the bottom line, all wrapping up a record year.
And that right there is the foundation of the whole paradox we're talking about.
Exactly.
When a company with these kinds of infrastructure tailwinds posts record numbers, beats the street on sales and earnings, why do we see a 4% drop right away?
It signals that the market is looking past all that success. It's looking past the history and focusing on one single question. What's going to happen in 2026?
That's it.
The stock reaction is basically a statement. It's saying that all this operational excellence, which we're about to get into, is being completely overshadowed by these near-term cyclical fears and the cautious guidance. But to really get why management is so confident, we have to appreciate the machine they've built.
Let's talk profitability then, because this is where the Mueller story it has fundamentally changed. The margin expansion is the undisputed success story here.
It's truly structural. And it's so much more important than any one quarter sales figure. Just look at the Q4 gross margin. It expanded dramatically, leapt 500 basis points year over year to 36.8%.
500 basis points.
500. And they said this was from core manufacturing efficiencies, better volume, and, favorable price-cost dynamics.
And I think it's important to put that in context. These results were delivered despite the ongoing headwinds from tariffs.
Right. Which management was very clear are still a big factor.
So achieving that kind of margin expansion while you're absorbing a known cost headwind like that, it really speaks volumes about their operational discipline.
And the full year just confirms this quality shift. Adjusted EBITDA hit a record 24.1% margin in Q4. The full fiscal year 2025 margin was 22.8%. That's a 110 basis point expansion over the prior year.
Okay.
And this is the key point. Management highlighted that over the last 2 years, they've achieved over 600 basis points of gross margin expansion.
Wow.
That kind of improvement is not a flash in the pan. That reflects permanent changes, automation, closing down old foundries. This whole transformation has really cemented MWA as a quality compounder.
And that success feeds directly into the balance sheet, right?
Yeah.
How did that operational alpha translate to cash?
Exceptionally well. Full-year free cash flow was very robust at $172 million. That represents about 84 to 85% of adjusted net income, so comfortably ahead of their own targets.
And their balance sheet strength is just remarkable.
Pristine is the word I'd use. Total debt is at $451.6 million, but that's almost completely offset by a massive cash pile of $431.5 million.
So they're basically net debt neutral.
Pretty much. Think about that. Their net debt leverage ratio is about 0.1x. So for all intents and purposes, they're a net debt neutral company. They have no big debt maturities until 2029 and almost $600 million in total liquidity.
That flexibility is huge. It means they can go after aggressive growth and still keep up shareholder returns without any constraints.
And they did. They returned $56.9 million in FY 2025 and announced their 11th dividend increase since 2014. That's management signaling. We believe in the future durability of our cash flows.
Okay, and before we move on, what about those one-off charges?
Right, good point. The market likes clarity, and they got it here. The adjusted results excluded a $5.6 million warranty charge for some legacy metering products and about $3.7 million in reorganization charges.
So one-time items.
Exactly. Their exclusion just validates that the core operational beat was genuinely clean.
Okay, let's pivot from the operational side to the strategic infrastructure they're building for the future. We had a pretty big announcement on leadership and a big change in the capex strategy.
Yeah, the leadership change was handled about as smoothly as you could hope.
Okay.
CEO Marty Zakas, who really steered this whole margin turnaround, is retiring. That's effective February 9th, 2026. Paul McAndrew, who's the current president and COO, will just transition right into the role.
A planned succession?
The definition of one. And Zakas is staying on as a senior advisor through the end of 2026. It's crucial for keeping that operational focus that got them that 600 basis point gain.
Yeah, on the physical side, we saw them complete that new state-of-the-art brass foundry in Q4. That was a huge milestone.
Huge. It provides essential components for their valves and hydrants. And that new foundry is the immediate margin story. The benefits from closing the old, inefficient facility should fully annualize in the first half of 2026.
So those gains are already baked in.
They're baked in. But then the conversation quickly moved to the next round of investment. And I think this is where the market started to get a little bit nervous.
Right. They guided capex way up for FY 2026.
Yeah.
$60 to $65 million, which is 4 to 5% of net sales. That's a massive investment.
It is. And this capital is specifically for multi-year upgrades at two of their mature iron foundries. But here's the critical part that probably spooked some investors.
Okay.
Management was explicit. They cautioned that these big iron foundry investments are focused on future growth and capacity,
Right,
with no anticipated margin benefit expected in fiscal year 2026 from this specific spending.
So MWA is basically asking investors to stomach significant capex in 2026 with no immediate reward, betting that future demand will justify it.
You got it. And that links
Right.
directly to the guidance, which was the final straw for the market. The decision to invest heavily now, knowing it's going to suppress near-term cash flow, suggests they have extreme confidence in the long-term demand curve.
But the street just saw the 2026 numbers.
They did. And the sales figures were, without a doubt, the main driver of the sell-off. For FY 2026, net sales guidance is $1.45 billion to $1.47 billion.
Which implies what incredibly weak top-line growth, like 1.4 to 2.8% year over year.
Exactly. Analysts were quick to note that the midpoint of that range was meaningfully below the street's consensus, which was around $1.49 billion. For a company that just did 9.4% growth, guiding to less than 3% just immediately raises red flags.
And the assumptions they baked into that guidance really explained the caution. They were very transparent about it.
Yeah, they were. They are assuming a high single-digit decline in residential construction volume in the coming year.
Okay, and that's where they're exposed on metering and smaller connection products.
Right. But they forecast that this weakness will be offset by low to mid single-digit growth in their core business municipal repair and replacement, and then mid to high single-digit growth in specialty valves.
So that mix shift seems crucial. I mean, if margins are expanding, why should we care about 1.4% sales growth if it's just driven by an expected cyclical dip in residential? Isn't this just a margin story now?
That is a central question. It's prudent guidance. Management is flagging the risk they can't control, and they're still dealing with external headwinds like tariffs, which will impact about 3% of their cost of sales in FY 2026. But their confidence in overcoming all that is still really high.
And you see that confidence in the margin outlook.
Yeah.
And despite low sales growth and high capex, the margin expansion story just keeps going.
It does. Adjusted EBITDA guidance is $345 to $350 million. At the midpoint, that implies a 23.8% margin. That's another 100 basis point expansion over FY 2025.
And they kept the free cash flow target high.
Kept it high, greater than 85% of adjusted net income. This just shows you the quality of earnings isn't going down. The company is getting structurally more profitable every single year, regardless of that low top-line growth.
Which brings us to the broader context, the structural tailwind that the market seems to be just ignoring entirely.
Yeah, and this cannot be overstated. The structural environment for Mueller is exceptionally positive. They are directly tethered to the U.S. water infrastructure market, which has multi-year, predictable, non-cyclical support from the Infrastructure Investment and Jobs Act, the IIJA.
So that $50 billion for water projects, what does that actually mean for a company like MWA?
It means long-term visibility that frankly, very few industrial companies have. This isn't just a promise of money. The funding is actively flowing now. It gets allocated over several years, and it's for replacement, repair, resiliency, not volatile new construction.
So they're buying MWA's core products.
They're buying hydrants, gate valves, the specialty fittings crucial for these aging municipal systems. The IIJA provides a massive, stable demand floor that just dwarfs the impact of any cyclical residential downturn.
Yet despite all of that, the stock has materially underperformed. Over the last 3 months, MWA is down almost 13%.
While the S&P 500 was up over 8%, and even the water sector ETF was up over 4%.
That massive discount is the market telling us something specific.
It's telling us that short-term cyclical noise is just louder than the long-term structural signal. Investors are heavily discounting the pristine balance sheet, the transformation, the certainty of the IIJA. They are fixated on the 2026 guidance low revenue, residential decline, tariff pressures. The sentiment is bullish long-term, but tactically cautious for 2026. And that caution is what punished the stock.
All right, now it is time for our final segment, and we have to remind you, this is analysis for thought exercise only. We're summarizing and analyzing the earnings call content. This is absolutely not financial advice. You should always do your own research.
Okay, so if we were to construct a trade idea based on this central tension we've been talking about, the conflict between the structural margin story and the temporary sales weakness, you'd want to isolate that operational alpha.
Let's hear the setup.
The setup is this. NWA is turning into a high-quality cash compounder tied to critical infrastructure funding, but it's being priced like a cyclical housing play just because management was honest about their guidance. The fear is quantifiable.
So how do you neutralize that specific fear, but keep the bet on their execution?
The trade. You'd initiate a long position in Mueller Water Products while simultaneously running a hedge short against a purely residential construction proxy. Let's say an index or an ETF that tracks major single-family home builders.
So you're essentially saying, I believe management's guidance on the residential side, but I also 100% believe their guidance on their own operational improvements.
Precisely. This isolates MWA's operational alpha, that 100 basis point margin expansion fueled by their efficiency and the municipal demand, from the cyclical housing risk that they explicitly flagged. If MWA successfully delivers that margin expansion while the residential market shrinks just like they guided, this structure captures the stability and profitability of the water utility market while hedging out the main fear factor that's depressing the stock. You're betting the CEO transition and the capex are smart long-term moves, and you're neutralizing the temporary drag.
A fascinating way to filter out the noise. So, to recap our deep dive, Mueller Water Products delivered record operational performance, validating its entire multi-year transformation program.
But the market reacted very poorly to the conservative 2026 sales guidance, which explicitly bakes in that residential housing decline. And this near-term caution just completely overshadowed the structural margin expansion, another 100 basis points expected, and that exceptional balance sheet.
And we can't forget, the CEO transition is smooth, and they're committing heavy capex, 4 to 5% of sales, to upgrade those iron foundries for future capacity, even with deferred margin benefits.
Which leaves us with a provocative final thought for you to consider. The company's willing to absorb large margin-dilutive capex right now because they seem to have visibility into future demand supported by the IIJA. So, is the market being short-sighted? Are they punishing the stock for what is really just disciplined, aggressive investment for the next decade of growth? What does MWA's commitment to immediate capacity expansion really signal about the enduring quality of their long-term order book?
That is certainly something to mull over as you integrate this into your own research. Thank you for joining us for this deep dive. We'll see you next time.